the trend is up. Gold just hit an all-time record high. We're nowhere near the top of this cycle. Gold prices, I think, are going to move up multiples of where they are right now, many multiples. So we're still very close to the low end of where gold's going to be trading in the not too distant future. Silver hasn't even taken out a high yet. I mean, silver's still under $30 an ounce. One day you're going to look back at $50 silver and say, gee, that was really cheap. And with silver, I mean, it's going to blow through $50, and maybe it'll be support for a while before, it's really like a launch pad, and the prices go much higher. But it's not so much silver getting more expensive. It's fiat currencies losing value. It's going to be very difficult for them to lower rates. They still need to raise rates, and they're going to raise rates. They just, they don't know how to do it, because you can't do it without disrupting the markets. I mean, they started to raise rates, and the Nikkei collapsed. Between a Friday and a Monday, it was down 20%, and it was the biggest. The Monday in Japan was the biggest decline. And the Bank of Japan panicked on that Wednesday. The market had a rebound on Tuesday, and it was probably going to roll over and make new lows. And then the Bank of Japan came out and said, hey, we're not going to hike rates anymore if the markets are destabilized. And then everybody bought stocks, and everything is great, because the Bank of Japan basically said we're not going to raise rates, because there's no way to raise rates without destabilizing the markets. But if they don't raise rates, the inflation problem in Japan is going to get worse and worse and worse. And so eventually they're going to have to do it. The question is, how much longer can they hold out? But for years and years, the Japanese created inflation under the pretense that they didn't have enough inflation. Well, that was a lie. There's nothing wrong with low inflation. In fact, deflation, prices going down, is actually better than prices going up slightly. But they bought into this nonsense that inflation should be 2%, and that if it's 0.5%, then there's a problem that the central bank needs to solve. Well, that is absolutely ridiculous. You don't have to solve that problem. Prices going up 0.5% per year are better than prices going up by 2% a year. So there's nothing to worry about. Right? It's like nonsense. Nobody wants the cost of living to go up. Everybody wants prices low. And if prices go down, that's better than prices going up. So it's all nonsense that economies do better when prices are rising. They do better when prices are falling. And strong economies cause prices to fall because they produce more stuff. More supply means lower prices. So the government was fighting a fictitious battle. The real reason the Bank of Japan kept interest rates low was to suppress the yen and to prop up the government in Japan, and to prop up companies that had taken on too much debt that might have gone under. Companies going bankrupt that need to go bankrupt, it's better than having zombie companies continue indefinitely, propped up by the government. And forcing the Japanese government to cut spending is better than subsidizing massive debt. Now, if you look at the Japanese debt to GDP, it's enormous, 225, 250%. And one of the main reasons the Bank of Japan can't raise interest rates is because the government of Japan can't afford it. The only way the government of Japan would be able to afford to pay those rates would have to be to raise everybody's taxes to get the extra income, but they don't want to do that. So instead, we're going to raise everybody's prices by creating inflation. But Japan is in the same box that the Fed is in, that the European Central Bank is in, that the Bank of England is in. All of these central bankers made the same mistakes. They all kept interest rates too low. They all subsidized their governments to go deeper into debt by doing their own version of quantitative easing, asset purchases. So now all these countries are loaded up with debt, not just on a public level, but on a corporate level, on an individual level, and everything is going to collapse.
Peter Schiff's analysis of the global economic situation, particularly with regard to Japan's financial woes, provides a stark reminder of the precarious balance central banks around the world must maintain. Schiff highlights the impossibility of raising interest rates without destabilizing markets, a dilemma faced by the Bank of Japan, BOJ, and, by extension, other central banks globally. The recent attempt by the BOJ to raise rates is a textbook example of how difficult it has become to implement such policies without triggering significant market disruptions. Schiff recalls how the Nikkei index plummeted by 20% over a weekend, illustrating the fragility of the financial system. The BOJ's subsequent decision to backtrack on its rate hike in an effort to stabilize the markets underscores the central bank's predicament. They are stuck between a rock and a hard place. If they raise rates, they risk crashing the markets. If they don't, inflation continues to spiral out of control. The problem, as Schiff points out, isn't just unique to Japan. The same narrative is unfolding in the United States, the European Union, and the United Kingdom. All these economies have been operating under a low interest rate regime for years, artificially inflating asset prices and encouraging excessive borrowing. This has led to an unsustainable level of debt across the board, government, corporate, and individual. The result is a ticking time bomb that could explode with devastating consequences for the global economy. Schiff argues that central banks have been fighting a fictitious battle against low inflation, using it as a pretext to justify their ultra-loose monetary policies. He asserts that deflation, where prices decrease, shouldn't be feared, but rather embraced. Lower prices increase purchasing power, which is beneficial for consumers. However, central banks have perpetuated the myth that inflation must be kept at 2% to maintain economic stability, a notion Schiff dismisses as nonsense. The real reason central banks like the BOJ have kept interest rates artificially low, according to Schiff, is to prop up their respective governments and prevent heavily indebted companies from going bankrupt. This has created a generation of zombie companies, businesses that can only survive in a low interest rate environment and would collapse if rates were to rise significantly. The same can be said for governments, which have become addicted to cheap debt to fund their deficits. Japan's debt-to-GDP ratio is a staggering 250%, one of the highest in the world. This makes it virtually impossible for the Japanese government to service its debt if interest rates were to rise substantially. The only way out of this dilemma, as Schiff sees it, is through inflation, by devaluing the currency and effectively reducing the real value of the debt. But this is a dangerous game, as it leads to rising prices and eroding purchasing power for the average citizen. In such a precarious economic environment, Schiff emphasizes the importance of holding tangible assets like gold and silver. He predicts that the price of gold, which recently hit an all-time high, is nowhere near its peak. As central banks around the world continue to print money to service their debts, the value of fiat currencies will continue to decline. This will drive up the price of gold and silver, not because these metals are becoming more valuable in real terms, but because the currencies used to buy them are losing value. To put this into perspective, Schiff draws a historical comparison. When the Federal Reserve was created in 1913, an ounce of gold cost $20. Today it costs around $2,500. This represents a 99% decline in the purchasing power of the US dollar over the past century. Schiff warns that the pace of this decline could accelerate in the coming years, with the dollar potentially losing another 90% of its value within the next decade. If that happens, the price of gold could skyrocket to $25,000 per ounce, or even higher. The same logic applies to silver, which Schiff believes is vastly undervalued. While silver prices have not yet reached their previous highs, Schiff argues that it's only a matter of time before silver follows gold's trajectory. Historically, silver has often outperformed gold in percentage terms during bull markets. Schiff suggests that the $50 per ounce peak seen in 1980 and 2011 will seem like a bargain in hindsight, as silver prices could soar well beyond that level.
I think that people might get scared out of the market. The biggest days in gold and silver are generally on the downside, but they're just one day. The trend is up. Gold just hit an all-time record high. We're nowhere near the top of this cycle. Gold prices, I think, are going to move up multiples of where they are right now, many multiples. So we're still very close to the low end of where gold's going to be trading in the not too distant future. Silver hasn't even taken out a high yet. I mean, silver's still under $30 an ounce. It double topped at $50 an ounce in 1980 and in 2020. One day you're going to look back at $50 silver and say, gee, that was really cheap. And with silver, I mean, it's going to blow through $50, and maybe it'll be support for a while before, it's really like a launch pad, and the prices go much higher. But it's not so much silver getting more expensive. It's fiat currencies losing value. When the Federal Reserve was first created, in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. The dollar has lost more than 99% of its value ever since we turned it over to the Fed. But if you go back to when the Republic was started in 1789, when we ratified the Constitution, you needed $20 to buy an ounce of gold in 1789. And in 1913, it still was $20 to buy an ounce of gold. So our money had stable value. In fact, it increased in value. Prices were half in 1900 what they were in 1800. So when we didn't have a Federal Reserve, when we had sound money, when we had gold and silver as money, prices went down and the dollar maintained its value, actually became more valuable. But ever since we turned it over to a central bank, the dollar's been destroyed. But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, or but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'll be 25,000. And that's just 90%, not 99%. Then you'd have to add another zero. 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings. It's a way to protect your purchasing power. It's better than keeping your money in cash. Even if that cash pays a small amount of interest, it's still not enough to offset the inflation. So it's still a negative interest rate. And so a zero interest rate on gold is better than a negative interest rate on cash. And, sometimes if you think that assets are too expensive, if the stock market is high, if real estate is overpriced, and you want to have dry powder, it's much better to keep your dry powder in gold and silver than in a fiat currency, because it's possible that when you need the dry powder, your fiat currency is going to be all wet because inflation is going to destroy it. I mean, even if asset prices come down, they may not come down in terms of dollars or euros, but they really could come down a lot in terms of gold, which is what I expect. I expect ultimately we're going to have deflation. The government is doing everything it can to prevent assets from deflating. But it won't work. Prices will deflate, just not in their fiat currencies. They can control that. They can make sure that prices always go up in the currency that they create, because that currency has no real value and they can create as much of it as they want. But what they can't prevent is prices from collapsing in terms of real money that they can't create, which would be gold and silver. And so that's what people should be holding if you are hoping to take advantage of a bargain, of a fire sale on assets, and you want to have the ability to buy them. The money you should be saving is gold and silver.
Schiff's prediction of a deflationary collapse in asset prices is grounded in his understanding of economic cycles and the unsustainable nature of the current financial system. He argues that despite central banks' efforts to prop up asset prices, deflation is inevitable. However, this deflation won't be reflected in fiat currencies like the dollar or the euro, which central banks can devalue at will. Instead, prices will deflate in terms of real money, gold and silver. This is a crucial distinction. Central banks can create unlimited amounts of fiat currency, but they cannot create gold or silver. This makes these metals a true store of value, as their supply is limited and cannot be manipulated by government policy. As the value of fiat currencies continues to erode, the relative value of gold and silver will rise, even as the prices of other assets fall. Schiff's analysis suggests that we're heading towards a scenario where inflation erodes the value of fiat currencies, while at the same time, deflation drives down the prices of assets in real terms. In such a scenario, gold and silver will be among the few assets that hold their value, making them indispensable in preserving wealth. For those who are skeptical of Schiff's predictions, it's worth considering the historical precedents. Throughout history, every fiat currency has eventually lost its value, often leading to periods of hyperinflation where prices rise exponentially. In such environments, the price of gold and silver tends to rise dramatically as people seek to preserve their wealth. Schiff's recommendation for owning physical gold and silver is not just theoretical, it is deeply practical. He emphasizes that owning these metals is not about making a quick profit, but about securing your financial future. Unlike stocks or bonds, which are paper assets dependent on the solvency of a company or government, gold and silver are tangible assets that you can hold in your hand. This tangibility provides security in uncertain times. If the financial system were to collapse, or if there were a significant devaluation of fiat currencies, gold and silver would still have value. This is why Schiff advises against holding gold and silver in electronic or paper form, such as through ETFs or certificates. He argues that if you don't hold the metal in your possession, you don't really own it. In a crisis, you want to have direct access to your assets, not a promise from a third party. Schiff also highlights the importance of understanding the different types of gold and silver available to investors. Whether it's coins, bars, or rounds, each type of metal has its own advantages and disadvantages depending on your goals. For example, gold coins are often more liquid and recognized worldwide, making them easier to sell or trade in an emergency. Silver, being more affordable, allows for the accumulation of larger quantities, providing more flexibility for smaller transactions. Schiff's analysis extends beyond just gold and silver. He sees the current economic situation as part of a broader trend towards the devaluation of fiat currencies and the eventual collapse of the financial system as we know it. He warns that the policies of central banks and governments are leading us down a dangerous path, one that could result in widespread economic hardship. In such an environment, the traditional safe havens of stocks, bonds, and real estate may no longer offer the protection they once did. Instead, investors will need to look towards real assets like gold and silver, which have historically provided stability in times of economic turmoil. This isn't just about protecting your wealth. It's about preparing for a future where the rules of the game have changed. As central banks continue to devalue their currencies, the value of gold and silver will only become more apparent. For those who act now, there is an opportunity to not only preserve wealth, but also to profit from the inevitable rise in the price of these metals. While Schiff's analysis is compelling, it's important to approach the situation with a balanced perspective. No one can predict the future with absolute certainty, and there are always risks involved in any investment strategy. However, the case for gold and silver as part of a diversified portfolio is strong, particularly in the current economic climate. For those new to investing in precious metals, it's important to do your research and understand the market. There are many resources available, from books and articles to podcasts and investment forums, where you can learn from experts and fellow investors. To help build your knowledge and stay informed, consider engaging with the broader precious metals community. Platforms like Twitter, Reddit, and YouTube are filled with discussions, analysis, and advice from people who have been investing in gold and silver for years. For example, following thought leaders like @Schiff on Twitter can provide daily insights and updates on the market. As Schiff eloquently argues, the time to act is now. The economic storm clouds are gathering, and those who fail to prepare could find themselves caught in the deluge. Gold and silver offer a way to protect your wealth and preserve your purchasing power in the face of an uncertain future. Investing in precious metals is not just about making a profit, it's about securing your financial future. Whether you're a seasoned investor or just starting out, now is the time to consider adding gold and silver to your portfolio. As Schiff puts it, in a world of fiat currency, gold and silver are the ultimate safe havens. Don't wait until it's too late. Take action now to protect your wealth and your future.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.